Hello class, I welcome you all to this session. This session we are going to discuss a new chapter, Financial Management and Financial Planning. Financial management is concerned with management of flow of funds and involves decisions relating to procurement of funds. We call this as financial decision. Investment of funds, that is investment decision, and distribution of earnings to the owners, that is dividend decision. So financial management is concerned with these three decisions. One is the investment decision, financing decision, and dividend decision. So how to actually procure funds will be discussed under financial decision, financing decision. How to actually invest the funds profitably will be discussed under investment decision, and how to distribute the earnings to the owners will be discussed in the dividend decision. Now, financial management has a major objective to ensure maximization of shareholders' wealth. It's going to maximize the wealth, that is called as a financial management. The role and importance of financial management is ensuring availability of enough funds and avoiding idle funds. Idle funds are dangerous to any business because it is a cost to actually safeguard the fund and without earning any return. Okay, so it's like a double-edged sword. So some of the examples of this importance are composition of fixed assets of the business, that is capital budgeting decisions. So how much of fixed assets you're going to purchase in that particular business, that those are called as capital budgeting decisions. It involves huge funds. Okay, it involves huge funds. If you imagine you want to purchase a plant and machinery for a factory, so once this decision is taken, it's very difficult to actually get out from it because it involves huge funds. Second example is the quantum of current assets as well as its breakup into cash, inventories, and receivables, that is working capital requirements. So what is going to be my working capital requirement if I'm going to run my business? So that quantum of current assets needs to be segregated and kept correctly in terms of cash, inventories, and receivables. The third category is the amount of long-term and short-term financing to be used. So long-term and short-term financing to be used. What's going to be my short-term financing? What's going to be my long-term financing? The next category is the breakup of The next category is the breakup of long-term financing into debt, equity, that is the financing decision, and all other things that's related to the P&L account, that is interest, expenses, and depreciation, etc., should be stated here. Okay, so financing decisions will deal with all these things so that finance can be managed properly to actually maximize the shareholders' wealth. The objectives of financial management, as I told you previously, it is maximization of shareholders' wealth, maximization of current market price of equity shares of company. That is, uh, about 20 years ago, in the year of 2002, Infosys share price was 11 rupees. Now the share price of Infosys is almost 1,600 something. Okay, so I've just checked it yesterday. It's 1,600 or 1,000. It has anticipated to go up to 1,700, 1,800, or even 2,000 for that matter, 1,900 for that matter. Okay, so it keeps fluctuating, but imagine the growth over a 20 years time. So it's like a maximization of current market price of equity share of the company is the ultimate goal. How it can be achieved? Number one, benefit should exceed the cost. That is the number one rule. The benefit that the business is catering to the society should exceed the cost that is incurred. So in that case, it will be able to maximize its shareholders' wealth. The first one is ensuring availability of sufficient funds at reasonable cost. The second was ensuring effective use of funds. The third is ensuring safety of funds. So these are the things that need to be kept, how to achieve this maximization of shareholders' wealth. One is ensuring availability of sufficient funds at reasonable cost. Then ensuring effective use of funds. You have to use the funds effectively. And then ensuring safety of funds. So these are the objectives of financial management. Coming forward to what is financial planning. Preparation of financial blueprint of an organization's future operations, that is called as financial planning. So it's like a blueprint. Okay, so what's going to be the financial planning, what's going to be, how the finance is going to be applied in the future, that is called as financial planning. How much funds is going to come, how much funds is going to go out, and how much we are going to invest, all these things is financial planning. Funds has to be available at the right time for the right plan that will lead to growth. Okay, the process of estimating the funds requirements of a business and specifying the source of funds is called financial planning. Okay, so I'll repeat this one more time. The process of estimating the funds requirement of a business and specifying the sources of funds is called as financial planning. Financial planning's objective is majorly two. One is ensuring availability of funds on requirement. That is, funds should be available at the time of requirement. Long-term assets, either for purchasing of long-term assets or spending for the day-to-day expenses. The second objective is to ensure firms does not raise resources unnecessarily. If the funds are raised unnecessarily, it leads to idle funds. Idle funds, as I told you, it's a double-edged sword. It will actually increase the cost of maintaining the fund, and if you're not investing, it will not provide you returns also. So it's like a depreciation of currency. So excess funds increases the cost, idle resources, and wasteful expenses. Unnecessarily you try to expend those funds, which is not good for the organization. So these are the objectives of financial planning. One is the availability of funds on the at the time of requirement, and not raising unnecessary funds. Okay, so that the resources can be effectively utilized. The comparison between financial management and financial planning. Financial management means it aims at choosing the best investment and financing alternatives by focusing on their cost and benefits. So it's just what does it aim? Financial management aims at choosing the best investment and financing alternative by focusing on their cost and benefit. What is the aim of financial planning? Financial planning aims at smooth operation by focusing on funds requirement and their availability. The objective of financial management is maximizing the shareholders' wealth. The objective of financial planning is effective utilization of funds. The next one that we are going to discuss is the financial planning begins with the sales forecast. So how does financial planning begins? So first you need to know what is the revenue that's going to come into your business. Okay, what is the inflow? That's called as sales forecast. Then estimating profits during the period. Get idea of how much of the funds requirements can be met with retained earnings after payment of dividend. Okay, so estimated profits during the period after the dividend, what's going to remain in the business, how much it has to raise from external sources. Okay, so it's giving a entire picture of what is going to be the retained earnings and how much you are required to be raised externally. So that is called as financial planning. Financial planning importance, some of the importance are: number one, helps in forecasting future in different business situations. Say for example, if you're going to have a 10% sales forecast, so it's going to be 10% increasing year after year, then your revenue is going to be increasing to that trend. So obviously how you're going to respond to it? Okay, suppose your revenue is going to decrease for 5% by 5%, then how you're going to respond to it? So helps in forecasting future in different business situations. The second one is helps in avoiding business shocks and surprises. So you're planning ahead. Obviously if you're planning ahead, there's going to be a known approach, that is you are ready to the the outcome. So obviously it does not bring you shocks and surprises. The third one is coordinating various business functions by providing clear policies and procedures. So coordinating with various business functions by providing clear policies and procedures. Fourth one is it reducing waste, uh, duplication of efforts, gaps in planning and confusions. It reduces waste, duplication of efforts, gaps in planning and confusions. It link the present with the future. So obviously present with the future. If you're going to do effective management today, your future is going to be better. Okay, so like that, especially in terms of funds. Then fifth one is link the present with the future. Then sixth one is provides links between the investment and financing decision. Seven, makes evaluation of actual performance easier. So these are the importance of financial planning. So if you plan it correctly, you will be able to measure your actual performance because your standards would be set clearly. You'll have a link between the investment and financing decision, how much you need, how much you're going to invest. Then the future is going to be little secure and prosperous, and you're going to minimize the waste and duplication of efforts, gap and confusion, all those things. And you're going to have a well coordinated organization. You are going to experience lesser amount of shocks and surprises. It helps in forecasting future in different business situations. We are come to an end of the session. So I'll see you in the next session. Till then, take care. Bye.